The information provided in this program is of a general nature and is not intended to be personalised financial advice. We encourage you to seek appropriate advice from a qualified professional to suit your individual circumstances. Ray, thank you so much for joining us. What do you make of the meme stock movement?
Thanks. It's a pleasure to be on the show. So going back to the meme stock movement, I think if you go back to 2020 and 2021, it was really symptomatic of bubble-like conditions, post all the COVID government handouts and the real resurgence in day traders. I remember watching these stocks and thinking to myself, what am I missing? So I decided to create an index just to track how they are going, and updated it quite recently. And what you see is that the index is down by about 75% from the peak in 2021. And the 17 sort of ASX meme stocks classified in that category actually peaked at a market value of about $12 billion. And the companies generated a loss of $350 million for the year. And so it was a real craze, and it was driven by speculation, particularly social media. And it's always difficult to recognize a bubble when you're in the heat of the bubble, given all the animal spirits and the emotion. But more often than not, when prices are moving really quickly, like 3 to 4 times the average of the market, and there are strong narratives attached to some of these stocks and sectors, the price will always end up catching up with the fundamentals. And particularly given this cohort of meme stocks on the ASX were generating quite substantial losses, eventually it was going to have an impact. And what we're seeing is that part of the market is down substantially, about 75% from the peak last year.
So do you think this is a phase, or is it more permanent?
I do think the resurgence in retail traders will be a permanent fixture of the market, just because there is a lot of low-cost brokers that are offering basically free trading or low-cost discount brokerage at $10 a trade. And what I've also noticed is the growth in social media tipping pages. So, for example, on Facebook, there's a group called ASX Tips, and that has about 56,000 members. And on Reddit, there's a group called ASX Bets, and that also has tens of thousands of members. So I think the speculative part of the market will always be there, but the growth of social media has really accentuated it. And a lot of these retail traders were inspired by a US-based retail trader who went by the name of Roaring Kitty, who was able to turn $50,000 into $50 million. And so you're always going to get people that are giving advice, which they shouldn't be, on these social media channels, and they're encouraging people to gamble. And so as an investor in the market, we stay well clear away from that part of the market. And we just acknowledge that there's always going to be some volatility in parts of the market.
Is it not a good thing to see investors so excited by stocks these days?
Look, I'm very passionate about investing, and I encourage people to invest themselves, but I also encourage people to get advice from financial advisors, because if you're not experienced in investing and you are relying on advice from social media promoters, you can lose quite a substantial amount of money. And when you look through these Facebook groups or Twitter groups, some of these investors are noticing quite substantial losses. And so what I'd say to investors is, number one is, wealth is always created slowly, and they should build a portfolio of good quality companies that pay dividends, that have good cash flows if they want to do it themselves, or see a financial advisor. But most importantly, I'd say don't speculate, because when you swing for the fences, you're aiming for 400% return on these penny stocks. Most of the time, these stocks are going to disappoint because they're not generating profits. And a lot of these companies use the share market to actually attract capital to have a bet effectively. Whereas you want to own a portfolio of companies that have good market position. So, for example, Commonwealth Bank of Australia, very dull, boring company. But if you look at the return on that stock over 10 years, it's over 200% plus dividends. And so you should always compound your wealth slowly and not speculate, because when you speculate, you do risk a substantial capital loss.
Ray, how is this any different, though, to analysts in the market who obviously are qualified, as you mentioned, but they're always hyping up stocks. They have their favourite picks, so it's always groupthink. How is it any different if it's just happening on social media?
Yeah, so It's a very good question, and often that gets thrown as a bit of a moral hazard. Is if you look at the brokers who are giving recommendations and advice, they're typically charging for that service, and these social media players have come to the market and said, well, we want to democratize the market and we want to give our own advice. But what I have noticed is that some of the companies within that sort of meme category are actually paying for promoters and influence to promote their stock. And I know this because ASIC has called this out, and also ASIC has pulled aside some of these influencers to warn them to say, hey, what you're doing is illegal. You can't promote a stock to get the price up, and so insiders could either sell or the company can raise capital because that's illegal. And so the broader professional industry, being the brokers, the investment banks, and the fund managers who are also writing about their own ideas, do it in a regulatory framework where they're not giving direct advice and they're not being paid for that advice by the company to promote it. And so there is quite a big difference. And so you've got to be careful that within, I guess, some of these social media sites, that there are promoters who have different agendas to other characters in the market, such as fund managers or brokers.
Still playing devil's advocate here, you run a long and short fund on Aussie equities. So realistically, you could actually just be shorting these hyped up meme stocks and making some money. So why are you calling them out?
So we run a long short fund, and the principal attributes of the fund is we invest in good quality companies that pay good dividends, that have been around for a long time, that have attractive valuations. On the other side of that is we do short low quality companies that either have crazy valuations that aren't supported by the fundamentals, that are either low quality, that are always prone to disappointment. And so when I looked at that index of meme stocks, we did actually have a couple of short positions in a number of those stocks, and one of those stocks in particular we're still short. And so if I look at the valuations of some of those companies, so I'll give an example of a company that's in that meme stock category. It's called Novonix. Novonix is a lithium technology startup company that has a reasonable sort of board and management, but it's very early stage technology. And the company's valuation peaked at about $5 billion of market value and had losses, and the technology was unproven. So we sort of looked at that and said, look, that's a lot of risk for that company. The valuation is not supported. We can buy another company on the ASX. So for example, Boral, which has a much lower valuation. Boral has been around for decades, has got really good assets that are hard to recreate. And it's an industry structure that's quite attractive, that generates a lot of cash flow. So that's how we play the market. And what you've seen is obviously over the long run, the market tends to reward companies that pay out, or that are profitable, that pay out dividends to shareholders, and that are growing. And the companies that have really extreme valuations where no profits end up eventuating get marked down. And you've seen companies like Novonix fall in value by about 90% from the peak because of the mismatch between the valuation and the profits they actually generate.
Can you tell me who you've shorted and who you're currently shorting?
So we don't tend to talk about our current shorts. Some of the short positions we've closed over time include some of these stocks in this meme category. So, for example, Novonix was one. Another one was a lithium developer that's got a really marginal project that's high costs, and we think that they won't be able to commercialize that project at lower lithium prices. Also, we've been short a lot of these consumer discretionary stocks because during the pandemic there was a lot of government stimulus that was put to the market, and people went out and splurged. And if you look at retail sales, particularly in Australia, they're significantly above trend. And so we're going into an environment where interest rates are now back to sort of 5.5% for mortgage rates. It's a big change from where it was 2 years ago. You got falling house prices, unemployment's peaked, and we think a lot of these retailers are going to experience tough conditions. And retail is a sector that's actually prone to restructuring and high levels of insolvency in tough conditions in previous downturns. So we're still short a number of these retail companies, and also we are short companies that have exposure to interest rate sensitive sectors, so particularly housing developers, because a lot of these companies who are developing real estate and housing have had to do it in a high cost environment, and they've developed these projects at pretty elevated inflationary levels, and they're going into an environment where demand's falling, and so they're going to be stuck with these high cost projects which they could end up taking a loss on.
Do you have the number on the top of your head, the percentage total return you made of shorting some of those meme stocks you mentioned?
Yeah, so on an individual basis, it varies because we always try. Well, there's a lot of volatility, and so when we look at the total return of our fund since inception, it's up by about sort of 14% versus the ASX benchmark. So really strong returns, and when you break down that return, about 30% of that is coming from the short book because, for example, for every $100 that we get to invest, we'll only use about $20 to $30 of that to short. And so we're not taking a substantial amount of money and shorting in the market. We're taking a small portion of the portfolio because we only want to short stocks that we're confident on that either have deteriorating prospects or that have valuations that can't be justified by the fundamentals.
Ray David of Schroders, thank you so much for your time and sharing so much shorting detail. Really appreciate it.
No, it's a pleasure to be on the show. Thank you, Madison.
Thanks for watching Markets with Madison, the New Zealand Herald show for interested investors. If you want to stay up to date with financial markets, click the subscribe button below and you can watch our other episodes here. Stay up to date with all the business news and numbers as they land on nzherald.co.nz.